we got this quote from Jefferies Strategists this morning. They say this week may start to mark the biggest shift in global monetary policy since Abenomics went into full steam on the appointment of Kuroda as head of the BOJ. Would you agree with that?
Not entirely. I'm not sure that the ECB is necessarily going to introduce new measures. From our suspicion is that the ECB will be tempted to let the measures already announced back in the summer to give them a chance to try and work before trying anything more dramatic in the form of quantitative. If it does come, it's likely to come next year, in our view.
All right. With that as the context, you continue to like European equities. Why?
Yeah, I mean, there's certainly little cause for cheer in the incoming economic data. There's no doubt about that. Germany's spluttering, France continues to choke, and while there's slightly brighter signs on the periphery, countries like Spain, their main export partner is France. So darker times lie ahead. However, there was some interesting data last week from Taiwan and Korea in terms of export data, showing that actually Eurozone exports to the Eurozone grew the fastest year on year versus US, China, and the rest of the world. So it's not necessarily all the same picture being painted.
So how much more upside do the European equity markets have in Europe, and how selective are you being?
Yeah, pretty selective, I have to admit, but I think there is considerable upside. I think if you compare it to the US, there's certainly greater earnings headroom for the European corporate sector versus the US corporate sector, and I think probably those sort of gradually thawing credit markets, alongside the sort of ECB's measures helping at the margin, probably mean that you want to have some exposure at least to some of the region's banks.
Like which ones?
The ones we like at the moment are KBC, BNP, and Popular. That gives us, in our opinion, a nice spread of exposures, and also maybe exposures to potential for margin surprise and bad debt surprise, in our opinion.
How big is this ISM manufacturing number going to be out of the US later, and how much more will this accentuate the split between the US and the Eurozone?
Well, in a sense, I mean, from a sort of sad strategist perspective, the ISM is your desert island statistic. It's got the longest longest track record of calling the US and the world economy right for the last sort of 50 odd years, and so really this number is huge. And the last few months have sort of painted a picture, particularly last month, suggested that we should be prepared for the US economy in the second half of the year to be closer to 4% GDP than the sort of 2.5% that the economists have penciled in. And so this month we're expecting a slight decline, but still suggestive of an economy in very strong expansionary mode. And I think the thing that we would say about the US economy is it's hard to imagine the US economy managing a brisker pace of economic growth and that economic warmth not spreading to the rest of the world. I think it's important for both Europe and Asia.